It is Wednesday, time for Mike on the Money. Mike Giordano, financial advisor with Williams Wealth Management, is joining us. Big day, Mike. The Federal Reserve decided not to hike interest rates today, the first time in more than a year that they've passed on raising rates. However, we should note they did say that they may raise rates twice more this year.
Right.
So what's going on? Why did they choose to do this?
Well, I mean, the high-level picture here is that the Federal Reserve is trying to cool the economy down just enough to get inflation under control, get prices to stabilize. That's the best thing to give both households and businesses confidence in the financial decisions they make. So that was their goal. So last year they were like, we got to get our car in the left-hand lane. J. Pound Company, we're going 70 miles an hour, cruising, getting rates up, hike, 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 hike. This year they moved it in the center lane, and now they're like, we don't want to overblow the exit. We don't want to put the economy in a recession. So now they're getting in the right lane so that they have a chance to reassess. And like you said, they think they got to go maybe 2 more exits before they might have to exit.
And then as soon as next month, potentially, for the next
Right.
one. So we'll be watching
Correct.
that. Okay, so you mentioned inflation. What exactly are we seeing when it comes to inflation right now?
Well, everyone likes to get excited about what the headline inflation is, overall inflation. So you saw it rocket up over 9% last year. It got people in a tizzy. Now it's down to 4%. And so a lot of people in the markets are very excited that, we've come down so much. What the Federal Reserve likes to do, though, is focus more on the core parts, because the headline number can be like chasing around a 3-year-old, and you get the sugar high, and then you have the crash, or the sugar high and the crash, right?
Terrifying.
So, yeah, and when they take a look at that middle part, it doesn't really look to be moving all that much. And so, the Federal Reserve is saying, rate cuts are very, very premature right now. We need to see more and more progress on prices coming down.
Taking a look at the markets, mixed close today. The markets seem to be taking all of this in stride. Can we expect that to continue?
Well, who knows? I mean, the market, it's hard to really decipher what's happening day to day. They are like the 3-year-old sometimes, the market. So it's very difficult. But right now we're in this little honeymoon period. We're on a Caribbean island, and, we keep hearing about the storm that might be coming, but it hasn't really come. And so there's a feeling like we're excited that the Fed might be close to finishing their rate hikes. We don't see the storm yet, so it's like party on.
All right. Well, that sounds nice.
Yes.
And in closing, in short, you say it is important to just have discipline as an investor.
Right, because that whole party on attitude is great for today, but
Yeah.
but you really basically want to stay disciplined, and staying disciplined financially means you don't get on that sugar high, you don't raid the candy jar, going for all the exciting stuff that's really rocketed up this year, and at the same time you don't get super fearful that the storm is definitely going to hit us. We're definitely going to get hit, and so you want to kind of just stay within your risk tolerance and stay balanced, because that's your best way of giving yourself what you need to achieve your long-term goals.
Awesome. Thank
Yeah.
you so much.
You bet.
Mike Giordano, financial advisor with Williams Wealth Management.